Welcome back, everyone. You're tuned in to the Crypto Strategist, XRP news, market insights, and institutional adoption updates. Today, we're diving into one of the most talked about predictions in the XRP community. A bold forecast is making waves across social media after Jake Claver suggested that XRP could potentially reach four-digit territory and, under certain circumstances, even approach the $10,000 level by 2026. Naturally, that kind of prediction grabs attention immediately. But as always on this channel, we're going beyond the headlines and digging into what was actually said, what evidence exists, and what investors should understand before getting carried away by viral clips. There's a huge difference between a possibility and a certainty, and today's discussion is all about separating documented developments from speculation. We'll examine the assumptions behind these forecasts, the growing tokenization movement, Ripple's expanding institutional presence, and the broader macroeconomic conditions that could influence the future of XRP. So stay with us until the end, because the full story is much more nuanced than many people realize, and understanding that nuance could make all the difference for serious XRP holders. One of the biggest reasons this prediction has generated so much discussion is because of the specific path Jake Claver outlined. During a recent conversation, he described a scenario where multiple major developments happen at roughly the same time. According to his framework, if global liquidity conditions shift dramatically, if institutional demand accelerates, if financial infrastructure begins relying more heavily on blockchain technology, and if tokenized markets expand rapidly, XRP could benefit in a substantial way. The headline-grabbing number, however, came from the upper end of that scenario. Claver suggested that under a combination of favorable circumstances, four-digit XRP prices could emerge, and if tokenized derivatives and broader financial markets migrate onto blockchain rails, even higher valuations might become possible. That statement quickly spread across social media, with many users focusing only on the price target itself. What often gets lost in the excitement is that the prediction was built upon multiple conditions being met. In other words, the forecast was not presented as a guaranteed outcome. It was a hypothetical pathway that depended on several major events occurring together over a relatively short period of time. What makes this discussion especially interesting is that Claver also addressed one of the most popular narratives circulating within the XRP community. Specifically, he spoke about the reverse carry trade theory involving Japan and global liquidity. This theory has been referenced countless times online as a potential catalyst for XRP adoption. However, during the discussion, Claver openly admitted that despite actively searching through official reports, central bank documents, and academic research, he was unable to locate any direct evidence connecting XRP to such a scenario. That admission is significant because it demonstrates the difference between logical speculation and documented planning. He explained that while it may seem reasonable to imagine a bridge asset like XRP playing a role in a liquidity event, there is currently no official documentation showing that major institutions have outlined XRP as part of that process. This is where many investors need to be careful. Just because an idea sounds plausible does not automatically mean it is supported by evidence. In fact, one of the healthiest approaches any investor can take is distinguishing between theories that are being discussed and plans that are actually documented. The reality is that viral narratives often spread much faster than detailed research. A short clip promising enormous returns can accumulate millions of views, while a nuanced explanation of institutional adoption may receive only a fraction of that attention. Claver himself acknowledged this dynamic. He noted that certain stories continue circulating because they attract engagement, regardless of whether supporting evidence exists. That observation is not unique to XRP. It applies across financial markets, cryptocurrency communities, and investing in general. Investors are naturally drawn to bold predictions and dramatic possibilities. The challenge is maintaining objectivity while evaluating those claims. This is why it is so important to examine original sources whenever possible. If a claim involves a central bank, a regulatory agency, or a major financial institution, the first question should always be whether official documentation exists. If the answer is no, then the claim should be viewed as speculation rather than fact. That does not mean the idea is impossible. It simply means that investors should understand the distinction and avoid confusing a theory with a confirmed development. While some of the speculative narratives remain unproven, there are other developments taking place within the financial industry that deserve serious attention. One of the biggest is the growing push toward tokenization. Over the past several years, tokenization has evolved from a niche concept into a major strategic initiative for some of the world's largest financial institutions. The idea is simple but potentially transformative. Traditional assets such as stocks, bonds, treasury products, and other financial instruments can be represented digitally on blockchain-based systems. This creates opportunities for faster settlement, improved transparency, reduced costs, and enhanced accessibility. Executives from major financial organizations have increasingly discussed tokenization as a key component of future market infrastructure. As this trend gains momentum, companies involved in blockchain technology naturally become part of the conversation. Ripple's participation in various tokenization initiatives has therefore attracted growing interest from both institutional observers and XRP supporters, who believe the company is positioning itself for long-term relevance in the evolving financial system. Another area generating considerable speculation involves the Depository Trust and Clearing Corporation, commonly known as the DTCC. Many XRP enthusiasts have pointed to various connections between Ripple-related technology and broader tokenization efforts involving major financial institutions. However, it is important to remain precise when discussing these developments. There is currently no official statement from the DTCC declaring that XRP will serve as a settlement asset for its future infrastructure. That distinction matters enormously. Some investors interpret indirect connections as confirmation, while others recognize that participation in an ecosystem does not automatically guarantee adoption of a specific digital asset. What exists today are certain technological relationships, collaborative initiatives, and infrastructure developments that create the possibility of future involvement. But possibility and confirmation are not the same thing. Understanding that difference allows investors to evaluate opportunities realistically instead of relying on assumptions. The excitement surrounding tokenization is understandable, yet responsible analysis requires acknowledging what has been formally announced and what remains uncertain. Despite the uncertainty surrounding some of these larger narratives, there are documented examples of Ripple technology being utilized in real-world financial initiatives. This is where the conversation becomes particularly important. Rather than focusing solely on speculative price targets, investors should pay attention to actual implementations. Several institutional pilots have explored how blockchain infrastructure can improve efficiency within traditional financial systems. These projects often involve tokenized assets, liquidity management solutions, and streamlined settlement mechanisms. The significance of these initiatives lies not in immediate price impact, but in demonstrating practical utility. Every successful pilot provides additional evidence that blockchain technology can solve real business problems. For XRP supporters, the broader implication is that growing adoption of blockchain-based financial infrastructure may create opportunities for Ripple and related technologies over time. Whether those opportunities ultimately translate into massive XRP valuations remains unknown, but the underlying technological progress is tangible and measurable in ways that speculation alone is not. One of the most discussed examples involves tokenized treasury products and the use of blockchain networks to facilitate redemption and liquidity processes. These types of projects illustrate how financial institutions are exploring new ways to manage assets in a digital environment. Rather than replacing traditional finance overnight, many of these initiatives focus on enhancing existing systems. That distinction is crucial because it reflects how institutional adoption typically occurs. Large financial organizations rarely abandon established infrastructure immediately. Instead, they gradually integrate new technologies where efficiencies can be achieved. Ripple's involvement in certain tokenization-related initiatives demonstrates that its technology is being considered as part of this evolution. For XRP holders, this represents a more concrete discussion than hypothetical price predictions. Institutional experimentation does not guarantee future dominance, but it does provide evidence that blockchain solutions are increasingly being tested within real financial environments. Over time, the cumulative effect of these developments could become more significant than any single announcement or headline. Another fascinating component of the broader XRP story involves the long-term relationship between Ripple and major asset management firms. Some institutions began exploring blockchain technology years before regulatory clarity improved. This persistence suggests that certain industry leaders view distributed ledger technology as a strategic investment rather than a temporary trend. One frequently discussed vision centers around the concept of unified financial wallets. Instead of maintaining separate accounts for banking, investing, insurance, and other financial activities, future users could potentially manage multiple asset classes through a single digital interface. Such a system could improve interoperability and create new opportunities for asset utilization. The idea remains ambitious, but it reflects a broader trend toward digitization within financial services. If tokenization continues expanding, wallet infrastructure could become increasingly important. This perspective shifts the conversation away from short-term price movements and toward long-term structural changes in how financial systems operate. For investors seeking to understand XRP's future, these larger trends may ultimately prove more meaningful than individual market predictions. The tokenization movement also raises important questions about market infrastructure. If stocks, bonds, treasury products, and other assets become tokenized at scale, institutions will require secure systems capable of handling issuance, custody, settlement, and interoperability. This challenge has created opportunities for blockchain providers to demonstrate their capabilities. Ripple's participation in various industry discussions and initiatives positions the company within this evolving landscape. However, it is essential to remember that the success of tokenization does not automatically equate to success for any single digital asset. Multiple technologies, networks, and platforms are competing to support the future of digital finance. Investors should therefore avoid assuming that tokenization alone guarantees a specific outcome for XRP. Instead, it should be viewed as a potentially favorable trend that could expand the overall addressable market for blockchain solutions. The ultimate winners may depend on factors including scalability, regulatory compliance, interoperability, institutional trust, and execution over the coming years. While adoption narratives often dominate crypto discussions, macroeconomic conditions remain equally important. In fact, broader economic forces frequently exert greater influence on asset prices than company-specific developments. Recent monetary policy decisions have highlighted this reality. Interest rates, inflation trends, and central bank guidance continue shaping investor behavior across global markets. When borrowing costs remain elevated, risk assets often face additional pressure because liquidity becomes less abundant. Conversely, periods of monetary easing tend to support higher risk investments, including cryptocurrencies. This relationship is not perfect, but it has historically played a significant role in market cycles. Therefore, any serious discussion about XRP's future should include macroeconomic considerations alongside adoption narratives. Even the most promising technological developments may struggle to drive sustained price appreciation if broader financial conditions remain unfavorable. Understanding this interplay helps investors maintain realistic expectations and avoid focusing exclusively on one aspect of the market environment. Recent policy developments have reinforced the importance of inflation and interest rate expectations. Policymakers remain focused on maintaining price stability, and elevated inflation continues influencing decision-making. Markets often react not only to actual rate changes, but also to forward expectations regarding future policy. When investors anticipate higher rates for longer periods, risk appetite can decline. This affects equities, cryptocurrencies, and other growth-oriented assets. For XRP and the broader digital asset market, the implication is straightforward. Adoption progress may continue regardless of macroeconomic conditions, but price performance can still be heavily influenced by liquidity dynamics. This distinction is critical because many investors mistakenly assume that positive adoption news should immediately translate into higher prices. In reality, multiple forces interact simultaneously. Regulatory developments, institutional activity, macroeconomic conditions, investor sentiment, and technological progress all contribute to market outcomes. No single factor operates in isolation. Another reason investors should approach extreme price predictions cautiously is the sheer scale involved. A move toward 4-digit or 5-digit XRP prices would require extraordinary levels of value creation, liquidity, and adoption. That does not make such outcomes impossible, but it does mean they would likely depend on transformative changes across global finance. Tokenization would need to expand significantly. Institutional participation would need to accelerate. Regulatory frameworks would need to mature. Market infrastructure would need to evolve. And perhaps most importantly, demand for blockchain-based settlement solutions would need to reach levels far beyond current usage. These are substantial assumptions. Serious investors should therefore evaluate such forecasts within the context of what would actually need to occur. Understanding the magnitude of the challenge does not diminish optimism. Instead, it encourages informed decision-making based on realistic assessments rather than emotional reactions to headlines. At the same time, dismissing XRP entirely would ignore several meaningful developments that continue unfolding. Ripple remains actively involved in discussions surrounding digital asset infrastructure, cross-border payments, and tokenization initiatives. Institutional interest in blockchain technology has not disappeared despite regulatory uncertainty and market volatility. In many ways, The industry appears to be entering a phase where practical implementation is receiving more attention than speculative hype. This transition could ultimately prove beneficial for projects capable of delivering measurable utility. XRP supporters frequently point to this shift as evidence that long-term adoption matters more than short-term market fluctuations. Whether one agrees with that perspective or not, it is clear that institutional experimentation with blockchain technology continues advancing. Observing these developments objectively provides a more balanced framework for evaluating future opportunities. Perhaps the most valuable takeaway from today's discussion is the importance of intellectual honesty. Jake Claver's comments generated attention because of the enormous price targets involved. Yet one of the most revealing aspects of the conversation was his willingness to acknowledge the limits of available evidence. Rather than presenting speculation as fact, he distinguished between documented developments and theoretical possibilities. That distinction should matter to every investor. The strongest investment theses are built on verifiable information, transparent assumptions, and realistic expectations. While there is certainly room for optimism regarding blockchain adoption, there is also a need for discipline when evaluating extraordinary claims. Markets reward informed participants far more consistently than emotional ones. By focusing on evidence rather than hype, investors place themselves in a stronger position to navigate whatever comes next. As we wrap up today's XRP update, the picture becomes much clearer. The tokenization push is real. Institutional experimentation is real. Ripple's involvement in various financial initiatives is real. Long-term discussions about digital asset infrastructure are real. However, many of the most explosive XRP price predictions remain dependent on assumptions that have not yet been validated. The Bank of Japan has not officially outlined an XRP-based liquidity strategy. Major institutions have not formally confirmed XRP as the settlement layer for every tokenized market, and the path to a $10,000 XRP valuation would require a combination of developments that remain highly speculative today. That doesn't mean such discussions should be ignored, it simply means they should be evaluated carefully. The most informed investors are those who can appreciate both the opportunities and the uncertainties. So now we want to hear from you. Do you believe the biggest story is the tokenization revolution, Ripple's institutional relationships, evolving regulatory clarity, or the broader macroeconomic environment? Let us know in the comments below. If you enjoyed this breakdown, make sure to like, subscribe, and turn on notifications so you never miss an XRP update.